Right now, the global nuclear industry needs something like 3 billion pounds of uranium just to keep the lights on over the next decade.
Yeah, 3 billion pounds. It's a massive number.
Right, 3 billion pounds. And yet, if you look at the actual contracting data, the utility companies that operate these reactors, they aren't buying it.
No, they're actively failing to replace the fuel they're burning today.
Exactly. And by every fundamental law of economics, I mean, when buyers step away from a market, the price of the commodity should just crater.
If it completely collapse.
But it's not. Instead, the long-term price of uranium is hovering in the mid-$90 range.
And if you ask the people actually pulling it out of the ground, it's heading rapidly toward triple digits.
Which is wild. We're looking at a market where the basic laws of supply and demand seem, well, entirely broken.
It really is a massive macro paradox. We are sitting at the very front end of a utility contracting cycle.
And normally, that's a period where buyers are sluggish.
Right. Buyers are sluggish, prices are soft. Yet we're seeing pricing structures that usually only appear at the absolute frantic tail end of a bull market.
Right.
The structural panic beneath the surface of the nuclear fuel cycle is just unlike anything we've seen in modern energy markets.
So if you are holding Cameco ticker symbol CCJ in your portfolio right now, or even considering taking a position, you need to understand exactly why this paradox is happening.
Because Cameco is sitting directly at the nexus of this entire global shift.
Exactly. So today, welcome to our special talk ticker style deep dive. We're stripping away all the Wall Street jargon, the corporate polish from Cameco's Q2 2026 earnings call.
We want to give you an actionable, data-forward breakdown of what is actually happening inside this company.
Right. We're going to dig into the headline numbers, explore the frankly strange reality of the physical uranium market, and unpack management's incredibly ambitious forward guidance.
And of course, distill what all of this actually means for your capital.
Because that's what matters. And the overarching theme of this deep dive is that you just cannot look at Cameco as only a mining company anymore.
No, definitely not. Between a confidential IPO filing for their Westinghouse asset and multi-billion-dollar financing vehicles being stood up by the U.S. government.
Which we'll get into because it's mind-blowing.
Oh, it really is. Cameco is no longer simply pulling radioactive rock out of the Canadian shield. They're attempting to capture the entire value chain of the global nuclear renaissance.
Okay, let's unpack this. We have to start by looking at the raw data for Q2 2026.
The headline numbers.
Right, because the automated financial screeners out there, they're telling a story that might actually, shake a casual investor right out of their position.
Oh, absolutely. If you just pull up the financial results for this specific quarter, they are technically lower than the incredibly strong second quarter they had last year in 2025.
And in the current market environment, any year-over-year dip in top line or bottom line metrics, it just triggers the algorithms to sell.
It prompts retail investors to panic and wonder if the whole growth thesis is fundamentally broken.
Which is exactly why relying on top-level screeners for a company that's heavily involved in massive infrastructure projects is just a huge mistake.
Right. To understand the year-over-year dip, you really have to look at how infrastructure accounting actually works.
Especially regarding their Westinghouse segment, right?
Exactly.
Yeah.
So last year, in 2025, Cameco's financials experienced this massive, essentially artificial spike because of a one-time milestone payment.
This was related to the Dukovany reactor construction project, right?
Yeah.
In the Czech Republic.
Yes, exactly. Let's break down that milestone payment concept for a second. When you are building a multi-billion-dollar nuclear reactor, the client, the Czech utility in this case, they don't just hand over a $15 billion check on day one.
Right. That would be insane.
And they also don't pay for it in smooth, even monthly installments like your Netflix subscription.
Right. So how does it work?
The revenue is recognized based on massive, discrete engineering or procurement milestones. It's called percentage of completion accounting.
Okay, so it's like a salesperson who landed a massive, once-in-a-decade whale of a client last year.
That's a great way to put it.
Their numbers this year might look a lot smaller by comparison, but their underlying business is actually healthier because they're doing the day-to-day work now.
Exactly. When Westinghouse hits a critical phase, say finalizing the front-end engineering design or taking delivery of a massive forged component, a huge payment is unlocked.
And last year, one of those giant Dukovany payments landed squarely in Q2.
Right. So when you compare this year's Q2, which reflects normal, highly profitable day-to-day operations, against a quarter that contained this whale of a project payment, of course the current quarter is going to look smaller.
So the financial dip is just an optical illusion. It's created by a tough comparison, not, some deterioration of the business.
And CEO Tim Gitzel spent a significant portion of his opening remarks hammering this exact point home.
Yeah, he really wanted to make sure the analysts got that. Because once you strip away the noise of the 2025 Duchovny payment, the underlying day-to-day metrics are actually accelerating.
And the data point that really anchors that acceleration is their production target.
Right. The first major data point we need to highlight, they are officially maintaining their 2026 outlook of 19.5 million to 21.5 million pounds of U3O8.
And holding that 20 million pound target steady is a critical signal for the market. Wall Street analysts were heavily anticipating a production downgrade this quarter.
Because mining is just a brutal, unpredictable business under the best circumstances, right?
Oh, absolutely. But doing it in the Athabasca Basin adds a layer of geological and logistical complexity that most investors fundamentally underestimate.
So reaffirming that 19.5 to 21.5 million pound target tells the market that their operational buffers are holding up.
Holding up against some intense physical headwinds, yes.
We will definitely get into those specific physical bottlenecks in Saskatchewan shortly, because the geography there is just central to the whole investment thesis.
It really is.
But sticking to the balance sheet for a minute, I want to zero in on the cost guidance. Management disclosed a slight uptick in their cost expectations for the year.
Right.
Now, whenever an infrastructure or mining company says costs are going up, my inflation alarm bells instantly start ringing.
Sure, you instantly think of spiraling labor disputes or, the cost of heavy machinery parts blowing out their capital expenditure budget.
Exactly. And that is exactly where the analysts on the call went as well.
But CFO Heidi Shockey stepped in to clarify the mechanics of this cost uptick, and her explanation completely diffused the inflation narrative.
Yeah, that was a crucial moment on the call. The increased cost guidance isn't driven by site-level operational blowouts, right?
No, not at all. It is almost entirely a function of foreign exchange rates.
Okay, let's track the mechanics of that foreign exchange impact for you. Cameco is a Canadian company. Their labor force is paid in Canadian dollars, and their local contractors are paid in Canadian dollars.
Right. But uranium is a globally traded energy commodity. And like oil or copper, contracts are priced in US dollars.
So you have a mismatch. A mismatch between the currency of their revenues and the currency of their localized operational expenditures.
Exactly. And lately, the US dollar has been incredibly strong relative to the Canadian dollar.
Which sounds good at first, right?
Yeah.
A strong US dollar boosts their top-line revenue when they repatriate those uranium sales back into CAD.
Right, but it creates massive friction on the cost side when they have to purchase specialized equipment or, specialized engineering services or certain raw materials from the United States or international markets.
Their Canadian dollars simply buy less abroad.
Exactly. What that actually translates to on the balance sheet is just a currency dynamic, not a systemic failure of their cost controls.
Right, the actual unit economics of getting a pound of uranium out of the ground haven't structurally degraded at all. The macroeconomic exchange rate just shifted the math on their imported goods.
Precisely.
So to wrap up the headline numbers for you, the year-over-year revenue dip is just a tough comparison against last year's massive check milestone payment.
The core production target of 20 million pounds is rock solid.
And the slight bump in cost guidance is just a 4x mirage, not runaway site inflation.
Which brings us to the operational reality of the global uranium market. Because holding those financial numbers steady is requiring a Herculean effort behind the scenes.
And this is where we need to examine that macro pricing paradox we mentioned at the start of the deep dive, the story behind the numbers.
Exactly. We really need to bring in the exact quote from Chief Operating Officer Grant Isaac here because it perfectly sets the stage.
I have it right here. He told analysts, quote, "We've never been at this kind of uranium price on the front end of a uranium contracting cycle."
And to understand why that is so anomalous, you have to look at the mechanics of utility buying behavior.
Right.
Right now, there is an estimated 3 billion pounds of uncommitted uranium demand globally.
Meaning, utility companies know they will need 3 billion pounds over the next decade to run their existing licensed reactors, but they do not currently have contracts signed to secure that fuel.
Correct. And the standard operating procedure for a nuclear utility is something called replacement rate contracting.
Okay, what does that mean in plain English?
If a utility burns 1 million pounds of uranium in a year, they go into the term market and sign a contract to buy 1 million pounds to replace it. It ensures their inventory never depletes.
Makes total sense. But Grant Isaac explicitly pointed out that across the industry, utilities are currently failing to contract at replacement rates.
They are burning more than they are buying.
And historically, when buyers retreat and fail to meet replacement rates, suppliers get desperate, right?
Yeah, they start slashing prices just to keep cash flowing to maintain their mines. Prices usually crash.
But right now, we're seeing the exact opposite. Utilities are dragging their feet, yet the long-term price of uranium is hovering in the mid-90s.
And market ceilings are stretching toward $160 a pound.
Which is just, it's crazy. To see prices this high when buyers are still sluggish, that indicates that a massive secondary supply of uranium has completely evaporated.
Yes. What's fascinating here is that utilities are finally realizing they have to pay production economic prices if they want suppliers to even bother mining it.
I think we need to unpack that secondary supply concept, because this is where the physics of the nuclear fuel cycle directly impact the stock price of a company like Cameco.
It's crucial. For years, utilities didn't have to pay true mining costs because they relied heavily on something called underfeeding at enrichment facilities.
Okay, underfeeding. This is a crucial mechanical concept for anyone investing in nuclear energy. Break this down for us.
Sure. So when you mine uranium, you get U-308, right? But you can't just throw that rock into a reactor.
Right, it doesn't work like coal.
Exactly. It has to be converted into a gas uranium hexafluoride, or UF6, and then it has to be enriched. Enrichment is the process of spinning that gas in massive centrifuges to separate and concentrate the fissile U-235 isotope.
And running those centrifuges requires an immense amount of energy and time, which is measured in separative work units, or SWU.
Right, SWU. For a long time, the price of SWU was incredibly cheap.
Largely because of excess capacity in places like Russia.
Yes. At the same time, the price of raw uranium was relatively high, so utilities and enrichers engaged in underfeeding.
Meaning what exactly?
Because the centrifuge time, the SWU, was so cheap, they would feed less raw uranium gas into the centrifuge, but they would spin it for a much longer time.
To squeeze every possible ounce of U-235 out of it.
Exactly. By running the machines longer and harder, they required less raw material to get the same amount of enriched fuel.
And then that saved raw material was packaged and sold back into the open market as a secondary supply.
You got it. Essentially, the enrichment facilities were acting like synthetic uranium mines.
Wow.
They were generating millions of pounds of supply without ever digging a hole in the ground, which artificially suppressed the price of real physical uranium for over a decade.
But geopolitics has violently reversed that dynamic, hasn't it?
Oh, totally. Following the invasion of Ukraine and the subsequent Western pivot away from Russian state-owned nuclear assets, cheap Russian SWU is being aggressively phased out of Western supply chains.
So suddenly, Western enrichment capacity is incredibly scarce, and the price of SWU has skyrocketed.
Right, so the math completely flips. You can no longer afford to spin the centrifuges for extended periods.
Instead, to meet their delivery contracts, enrichers are now overfeeding.
Yes, they are shoving massive amounts of raw uranium into the centrifuges and spinning it for a shorter duration. They are prioritizing time over efficiency.
And overfeeding destroys that secondary supply. In fact, it creates secondary demand.
Exactly. Enrichers now have to go out into the spot market and buy millions of extra pounds of raw uranium just to feed their own machines to meet their enrichment contracts.
So not only have utilities lost their synthetic supply of cheap uranium, but the enrichers themselves are now competing against the utilities to buy physical rock.
And that structural shift is exactly why prices are surging despite utilities failing to contract at replacement rates.
The utilities who are actually paying attention have realized the era of subsidized synthetic uranium is over.
If they want suppliers like Cameco to go through the immense capital expense, regulatory nightmare, and, frankly, the physical danger of sinking a new shaft, they have to guarantee a price that makes the mining actually profitable.
And Cameco is capitalizing on this realization with absolute ruthlessness. I mean, Grant Isaac detailed their market-related contract structures, and it is a masterclass in risk asymmetry.
It really is. Cameco is currently establishing floor prices, the absolute minimum they will accept for a pound of uranium regardless of how far the spot market might crash in the future, in the high $70 range.
And the ceiling prices, the maximum the utility will pay if the spot market goes into a hyper squeeze, are hitting around 160.
Right. Locking in a floor in the high 70s guarantees their Tier 1 assets will be incredibly profitable and insulated from macroeconomic shocks.
While a $160 ceiling gives them massive torque if the supply deficit truly breaks the market.
What is most impressive to me is their discipline. Management noted that several of their competitors are actively discounting their floors and ceilings just to secure long-term utility contracts.
They are giving away their upside just to get ink on paper.
Yeah. But Cameco is explicitly walking away from those negotiations. They are refusing to subsidize utility fuel costs.
And even by playing hardball and walking away from discounted deals, Cameco has still secured average annual deliveries of over 28 million pounds per year for the next 5 years.
Right. Now, if you compare that 28 million pound delivery obligation to their 20 million pound production target, you see a gap.
Pretty big gap.
They're managing that 8 million pound difference through a combination of drawing down their strategic inventories, opportunistic spot market purchases, and remaining perfectly flexible on when they ramp up their secondary tier of mines.
But executing that 28 million pound delivery obligation relies entirely on one massive assumption, doesn't it?
That they can reliably get that 20 million pounds of physical rock out of the ground in Saskatchewan.
Exactly. And this is the great hidden risk in commodity investing. I mean, you can build the most elegant pricing models and macro deficit projections on Wall Street.
But eventually, someone has to move heavy machinery into the frozen Canadian wilderness and physically extract a highly regulated radioactive element.
Right. And CEO Tim Gitzel made a very deliberate point on the call to remind analysts that operating heavily regulated assets in remote northern Saskatchewan is, quote, never without challenges.
He wasn't just managing expectations there. He was referencing the brutal reality of their Q2 operations.
Let's detail the specific disruptions they faced because it perfectly illustrates the fragility of the entire global supply chain.
So at Key Lake and McArthur River, which are two of the most critical uranium assets on the planet, they suffered unplanned operational disruptions purely due to the weather.
Specifically, the spring thaw. It deteriorated the northern ice roads and supply routes so severely that heavy logistics were essentially paralyzed.
Yes, mud. And it didn't stop with the mud. Right after the quarter ended, they had a 2-week total production suspension at Cigar Lake due to what they classified as technical challenges.
Let's talk about Cigar Lake, because Cigar Lake and McArthur River are not standard open pit mines.
No, not at all. They sit deep underground in the Athabasca Basin, where the high-grade uranium ore is surrounded by sandstone, and that sandstone is saturated with immense amounts of high-pressure groundwater.
Wait, so if you just drill into it, the mine floods instantly?
Instantly. It would be a catastrophe. To extract this ore, Cameco literally has to freeze the groundwater.
Freeze it? Like how?
They drill hundreds of pipes into the ground around the ore body and pump a super-cooled brine solution through them. It creates a massive, impenetrable wall of frozen earth.
Wow.
And only then can they safely send remote-controlled mining equipment in to scrape out the ore.
Okay, wait. I have to challenge the thesis here. You are painting this picture of Cameco as an unstoppable juggernaut, completely controlling the global pricing dynamics. But they literally just had to halt operations at their premier assets because the roads got muddy in the spring and because maintaining a subterranean ice wall is incredibly difficult.
Right.
If mining this stuff is so prone to delays just from bad spring roads, doesn't that make the global supply chain incredibly fragile? I mean, why should the market trust them with a monopolistic takeover of the global energy supply chain? Doesn't this fragility completely undermine the bullish narrative?
It's an excellent pushback, it really is. But you have to look at it from the perspective of a utility buyer. Yes, the supply chain is profoundly fragile. Yes, mining in the Athabasca Basin is logistically terrifying.
Okay.
But that extreme difficulty is exactly what creates Cameco's economic moat.
How does struggling to mine create a moat?
Because if Cameco, a company with 4 decades of specialized engineering experience, billions in localized infrastructure, and established relationships with indigenous logistics operators, if they struggle to hit production targets, what chance does a junior mining company have?
Right. There are dozens of small cap exploration companies out there promising to bring new greenfield uranium projects online in Africa or the American West.
Exactly. But utility fuel buyers know that if the undisputed masters of the Athabasca Basin are facing delays, those unproven junior miners are going to face catastrophic, decade-long inflationary blowouts before they ever produce a single pound.
So the sheer difficulty of the operation actually forces buyers to cluster around the only operator with a proven track record of surviving it.
Exactly. When the underlying reality of the supply chain is fragile, certainty of delivery commands an incredible premium.
Which explains their recent M&A activity. This is exactly why Cameco increased its ownership in the high-grade Cigar Lake mine.
Yes. They are consolidating control of these Tier 1 assets, large-scale, high-grade deposits that are viable through any market cycle because reliable supply is becoming the ultimate premium product.
Okay, so they have locked down the premier Tier 1 assets. They have forced utility buyers to accept floor prices in the high 70s, and they have insulated themselves against junior competitors purely through the overwhelming physical difficulty of the terrain.
That secures the raw material side of the business.
But raw uranium sitting in a drum doesn't power a city grid. It has to be burned.
And that transitions us to the third section, the most consequential part of this earnings call, management's guidance on Westinghouse and their strategy to monopolize the downstream deployment of nuclear energy.
Right, because Cameco has mastered the uranium rock. But the biggest revelation from the call is what they are doing with the reactors that burn it. Cameco acquired a 49% stake in Westinghouse in a joint venture with Brookfield Renewable Partners.
And this earnings call made it definitively clear that Westinghouse is no longer just a strategic hedge for them. It is the growth engine of the entire company.
Let's start with the elephant in the room that management desperately tried to avoid discussing, the confidential IPO.
Yeah, they tried to duck that one.
It was briefly noted in the filings that Westinghouse has confidentially submitted a draft S-1 registration statement to the SEC for a proposed initial public offering.
Naturally, every analyst on the call smelled blood in the water. They attacked this from like 4 different angles.
They demanded to know the strategic rationale, the target valuation, the timeline, whether Cameco was planning to dilute their equity.
And Tim Gitzel stonewalled them brilliantly. He invoked strict SEC regulations regarding the quiet period of a confidential filing, legally binding himself from discussing forward-looking details.
But while management can't discuss the strategy, we certainly can. I mean, you have to ask yourself, why would a consortium go through the massive leverage and regulatory headache to acquire the premier nuclear technology company in the world, only to turn around and file for an IPO less than 2 years later?
If you look at the public markets right now, there is a massive valuation arbitrage happening. The market is absolutely starved for pure-play nuclear technology investments.
Right, tech companies, data center operators, hyperscalers. They are desperately searching for clean, firm baseload power.
Because they realize wind and solar cannot support the 2047 power draw of an AI data center.
So if Westinghouse is floated as a standalone entity, the public market will likely assign it a massive technology multiple, completely divorcing its valuation from the cyclical, commodity-based multiples applied to Cameco's mining operations.
It is a textbook value realization strategy. Cameco is trying to unlock and realize the massive market value of Westinghouse without losing control of the asset.
And Tim Gitzel did give one critical piece of guidance hidden within his refusal to answer, didn't he?
He did. He explicitly stated that Cameco and Brookfield control Westinghouse today, and they do not expect that reality to change.
So this isn't an exit strategy.
No. They're likely planning to float a minority stake to the public to raise billions in cheap capital to fund Westinghouse's massive manufacturing pipeline while maintaining absolute strategic control over the asset.
And the scale of that manufacturing pipeline is almost difficult to comprehend, largely because the U.S. federal government has aggressively stepped in to underwrite the risk.
The management discussion laid out 2 jaw-dropping figures here. First, a $17.5 billion conditional commitment from the Department of Energy, the DOE.
And second, an $80 billion financing target being structured by the Department of Commerce, the DOC.
We really need to translate what these government vehicles are actually designed to do because they address the single biggest bottleneck in global nuclear deployment, the fabrication of long-lead items, or LLIs.
Let's define long-lead items.
Right.
When you build an AP1000, which is Westinghouse's flagship grid-scale reactor, you need massive, highly specialized metallurgical components.
Right. You need a reactor pressure vessel, which is a 300-ton forged forged steel cylinder that has to withstand incredible thermal and radiation stress without a single microscopic flaw.
You need steam generators. You need specialized coolant pumps.
And you cannot just order a 300-ton reactor pressure vessel on Amazon. There are only a handful of ultra-heavy forging facilities in the entire world, places like Japan Steelworks or Le Creusot in France, that possess the massive hydraulic presses required to forge these ingots.
So the wait list just to get your steel into the forge can be years long, and the fabrication process takes years more.
Historically, a utility company would wait until they had full regulatory approval, a finalized site plan, and a signed final investment decision before they would even order those long lead items.
Because why would you spend hundreds of millions of dollars on a pressure vessel if the local government might cancel the project?
Exactly. But because they waited to order the parts, the construction timeline stretched out to 10 or 12 years, exposing the utility to massive inflation and interest rate risk.
And this is where the government steps in. The $17.5 billion DOE commitment is designed to obliterate that timeline.
The federal government is effectively providing the credit facility to allow the domestic supply chain to start forging and manufacturing these long lead items now.
Speculatively, before the utilities have even finalized their paperwork.
Yes. It is about creating a prefabricated inventory of reactor components so that when a utility finally signs a contract, Westinghouse can deliver the hardest parts immediately, compressing the construction timeline from a decade down to just a few years.
And the $80 billion from the Department of Commerce acts as the demand-side catalyst. The DOC isn't funding supply chains. Their mandate is to harness foreign direct investment.
Right, to bundle international capital to provide the massive low-interest loans required for utilities to actually purchase and deploy these reactors globally.
I think it is essential to pause here and frame how we view this information.
Absolutely.
As analysts trying to extract actionable intelligence from an earnings call, we must evaluate these multi-billion-dollar government programs purely through the lens of their economic impact on Cameco's balance sheet.
Exactly. Regardless of your political affiliation, and regardless of whether you personally believe massive government energy subsidies are a wise use of taxpayer capital, our objective is to analyze the reality of the capital flows.
Right. We are not taking sides here. We are just looking at the facts. And the reality is that the U.S. government has decisively moved from rhetorical policy ambition to tangible, heavy industrial execution. They are mobilizing the federal treasury to de-risk the AP 1000 rollout.
With the government de-risking the supply chain, let's look at the actual commercial pipeline Westinghouse revealed in the call.
The data here is something I really geek out over. They disclose that they are tracking 91 identified reactor opportunities globally for the AP 1000.
Of those 91, 29 are in advanced active stages of negotiation.
And 11 have advanced to the advanced FEED stage, pre-FID final investment decision. Break down what FEED means.
FEED stands for Front-End Engineering and Design. This is the crucial, heavily capitalized precursor to pouring concrete. When a utility pushes a project into the advanced FEED stage, they are spending tens of millions of dollars to conduct geotechnical surveys of the specific site, model the environmental impact, and engineer the exact grid interconnections.
So a project in advanced FEED is highly probable. It represents real capital deployed, not just a memorandum of understanding.
Exactly. And the economics of actually executing these contracts are where the Westinghouse acquisition proves its genius. Management introduced a concept on the call called end-of-a-kind economics.
End of a kind. This concept is their direct rebuttal to the primary bearish argument against nuclear energy.
Yes. For the last 30 years, the public narrative around nuclear construction has been dominated by catastrophic cost overruns and delays.
A utility attempts to build a brand new, custom-designed, first-of-a-kind reactor, and they encounter thousands of engineering clashes during construction, causing the budget to blow out by billions.
We saw this recently with the Vogtle expansion in Georgia. But management's counterargument is that the AP 1000 is no longer a prototype. It has been designed, heavily licensed by the Nuclear Regulatory Commission, and successfully built and connected to grids globally.
The engineering is 100% complete.
Therefore, management is guiding that while initial twin pack projects, meaning a site building two AP 1000s simultaneously, might carry a capital cost of $20 billion to $26 billion, that cost will plummet as the supply chain standardizes.
They estimate that end-of-a-kind twin-pack projects will drop to between $14 billion and $17 billion.
And here is the metric that matters for a Cameco shareholder. Westinghouse captures roughly 40% to 45% of that total project value.
40 to 45% of a $15 billion project is a staggering top-line figure.
It really is. And Dominic Kieran, the global managing director, clarified the risk profile of that revenue. Because the reactor design is finished, Westinghouse is not acting as the general contractor.
So they are not taking on the localized risk of pouring millions of tons of concrete or fighting with local labor unions or managing on-site delays.
Right. Their slice of the engineering, procurement, and construction contract, the EPC, is almost entirely the procurement. They are simply selling the specialized high-margin parts,
which allows them to estimate a 20% average EBITDA margin over the full duration of a reactor project.
And because they are delivering those massive long lead items early in the process, the cash flow profile is incredibly front-loaded. Management noted that roughly half of the revenue for initial projects is recognized within the first 5 years of the construction cycle.
Here's where it gets really interesting. The upfront EPC revenue is just the hook.
Exactly. Once that reactor is fully built and synchronized to the grid, Westinghouse transitions to a recurring revenue model.
They estimate earning $45 million to $60 million in high-margin services, fueling, and outage maintenance per reactor per year.
And these AP1000s are engineered with a design life of 60 to 80 years. You are looking at a multi-generational, inflation-protected cash flow asset.
What is truly brilliant is that Grant Isaac pointed out that this $45 to $60 million recurring revenue is purely Westinghouse's share for engineering services and fuel fabrication. It does not include the actual raw uranium, the conversion, or the enrichment.
And who is perfectly positioned to sell the utility, the raw uranium required to fuel that reactor for the next 80 years. Cameco.
Yep. By controlling Westinghouse, Cameco has visibility into exactly when and where new demand will materialize globally, allowing them to optimize the deployment of their Tier 1 mining assets to capture the upstream margins, while Westinghouse captures the downstream margins.
It is a perfectly vertically integrated loop.
Before we move on to our final actionable takeaways, we need to quickly touch on the broader technology pipeline because it's not just grid-scale AP1000s.
Right. The MD&A highlighted two other technologies that drastically expand their total addressable market, the AP300 and the eVinci microreactor.
Let's start with the AP300. This is Westinghouse's entry into the small modular reactor, or SMR, market.
It is a 300 megawatt scaled down version of the AP1000. And Dominic Kieran made a brilliant strategic point regarding the AP300. Because it utilizes the exact same proven technology, the exact same physics, and the exact same supply chain components as the larger AP1000, Westinghouse requires uniquely modest capital to finalize the design.
They don't have to reinvent the wheel, they just have to shrink it.
Exactly.
Yeah.
This gives them a massive time to market advantage over competitors trying to design exotic, unproven SMR technologies from scratch.
And the AP300 is perfect for replacing retiring coal plants on existing grid infrastructure. But the eVinci microreactor is aimed at a completely different sector.
Oh, entirely different. This is a Generation 4 technology that produces a very small output, roughly 5 megawatts. It functions essentially as a solid-state nuclear battery.
A battery, so no moving parts.
Virtually none. It uses specialized heat pipes instead of pressurized water. You can manufacture an eVinci entirely in a factory, put it on a standard shipping truck, and deploy it to a remote mining operation in the Arctic, a forward-deployed military base, or, an off-grid AI data center.
And it provides uninterruptible power for 8 or more years without refueling, and when it's done, you put it back on a truck and return it to the factory.
And crucially, the development of the eVinci is currently heavily self-funded by grants from the U.S. government, providing Westinghouse with a free option to develop revolutionary tech without straining their own balance sheet.
So you have the AP1000 targeting national baseload power, the AP300 targeting industrial grids, and the eVinci targeting hyper-remote off-grid power generation. They have engineered a hardware solution for literally every scale of human energy demand.
Which brings us to the synthesis of all this data, the bottom line. We have parsed the headline financials, we have examined the paradoxical supply squeeze in the physical uranium market, and we have modeled the massive AP1000 deployment pipeline.
What does this actually mean for someone holding or considering CCJ stock? Let's start by translating management's core philosophy for actually executing this pipeline, which they call the 3 S's. Standardize, sequence, and simplify.
It sounds like corporate buzzword bingo, I know, but it is actually their overarching risk management strategy. It is their playbook for preventing the catastrophic cost overruns of the past.
Okay, let's break down the three S's. Standardize.
Standardize means they are vehemently refusing to custom-design bespoke reactors for individual clients. The utility buys the AP1000 footprint exactly as it is engineered, completely eliminating first-of-a-kind engineering risk.
Love that. Sequence.
Sequence means Westinghouse is actively coordinating with governments and utilities to ensure that the global supply chain isn't suddenly overwhelmed by 10 projects trying to pour concrete on the exact same day. They are staggering the builds to maintain a smooth, predictable flow of labor and forged parts.
And simplify.
Simplify means aggressively utilizing data from every completed build to iterate the construction process, accelerating the timeline to achieve those cheaper, end-of-a-kind unit economics.
Taking all of these mechanics into account, I will take a highly opinionated stance on this quarter. The data revealed in this earnings call is wildly bullish for the long-term holder of Cameco.
I completely agree.
The baseline profitability of their core mining business is practically bulletproof because the uranium price floor is steadily rising to the high 70s, even without the industry reaching replacement rate demand. Once utilities actually panic and begin contracting at replacement rates, that floor will hold and the ceiling will violently stretch.
I agree with the bullish outlook, particularly when you analyze the downstream bottlenecks. The nuclear fuel cycle does not end at the mine. As we discussed, uranium must be converted and enriched.
Right.
Currently, spot pricing for conversion and enrichment services is remaining incredibly elevated. The reason is that utility fuel buyers fundamentally distrust promises of new greenfield enrichment capacity.
They have been burned by geopolitical supply shocks, and they realize that only established, historically reliable operators can guarantee delivery.
This structural skepticism prevents new entrants from undercutting prices, keeping margins high across the entire fuel cycle, a cycle that Cameco touches at almost every stage.
Cameco knows they hold all the leverage, which is why they are patiently walking away from discounted utility contracts. They are perfectly content to wait for desperate buyers to capitulate to their pricing terms.
But to remain objective, we have to flip the script.
Right. If I'm an investor evaluating a long position, what is the bear case? Where does this seemingly flawless strategy break down?
The primary bearish risk for the Westinghouse segment is macroeconomic execution. A pipeline of 91 global reactors is a phenomenal spreadsheet exercise, but it remains entirely theoretical until utility boards authorize final investment decisions and the concrete actually cures.
And if global inflation remains sticky, or if central banks keep the cost of capital elevated, utility companies simply will not be able to borrow the $15 billion required to initiate a build.
High interest rates are the natural predator of nuclear infrastructure. If the cost of debt makes the AP1000 unviable, that entire 91 reactor pipeline will stall indefinitely.
And on the upstream raw material side, you can never discount the brutal physical reality of their operations. The Athabasca Basin does not care about Cameco's contract ceilings.
No, it doesn't. A severe, prolonged winter, a critical failure of a ground-freezing brine plant, or a logistical collapse on the northern ice roads could immediately halt production at a Tier 1 asset like McArthur River.
And if they suffer a catastrophic supply disruption, they will be legally forced to fulfill their 28 million pounds of annual delivery contracts by purchasing raw uranium on the open spot market at wildly elevated prices, which would instantly torch their operating margins.
It is an endless operational tightrope. They are attempting to fuel the most advanced energy transition in human history while fighting mud and groundwater in the subarctic.
Bringing this all together into our final actionable takeaway for you, the investor. If you hold CCJ in your portfolio right now, you are no longer simply making a proxy trade on the spot price of physical uranium.
Not at all. You are inadvertently holding a massive stake in a U.S. government-backed global infrastructure rollout.
If the Westinghouse IPO proceeds and the market assigns it a technology valuation multiple, and if the billions in DOE and DOC financing successfully catalyze the domestic supply chain, Cameco will achieve an unprecedented level of vertical integration.
They will control the engine, the AP1000 reactor, and the proprietary fuel required to run it for the rest of the century. They control the razor and the blade.
When you fully grasp the mechanics of what they are attempting, it completely alters the traditional valuation models assigned to this company.
If we connect this to the bigger picture, consider the geopolitical reality we just discussed.
Okay, leave us with one final provocative thought to consider before we wrap this up. We have mapped out the pipeline and the pricing power. Push the thesis one step further. Where does this end game lead?
Well, the U.S. government is deploying tens of billions of dollars to secure heavy forgings and reactor components because clean, firm energy is now classified strictly as national security.
Right.
At the same time, we established that global demand for raw uranium is massively outstripping the guaranteed reliable supply controlled by operators who can actually survive the Athabasca Basin.
Right. The secondary supply is gone.
So here is the scenario you must model as an investor. How long will it be before sovereign nations, terrified of supply chain collapse, energy grid failure, and hostile foreign actors, decide that they can no longer trust the open commodities market?
Oh, wow.
How long before a sovereign wealth fund or a consortium of allied Western governments decides to bypass the spot market entirely and simply attempts to buy out a Tier 1 asset like Cigar Lake directly?
Or, more provocatively, how long before they attempt a massive strategic equity buyout of Cameco itself, purely to secure their national grid?
When the frozen rocks in Saskatchewan are the literal key to powering the AI-driven future, those rocks transition from a traded commodity to a priceless national security asset.
That entirely redefines the ultimate ceiling for this stock. The raw data on the Q2 earnings release looked like a routine dip, but once we x-rayed the mechanics of the fuel cycle, a completely different operational beast emerged.
It's a completely different company than it was 5 years ago.
We want to thank you for joining us on this deep dive. Keep questioning the consensus, keep looking past the headline screeners, and we will catch you on the next deep dive.